Don't sell anything right now at low prices. Wait for things to improve. Use the carry trade profit to fill up your the holes in your balance sheet. Then in 2014, the economy will have turned. We'll do the stress test. We'll give you a pass, and everything will be fine. And we can go through this without Lehman Brothers moment in Europe. It kind of worked, except on the last part for Italy. Like the economy really never picked up. And yeah, they kept plugging in the profit from LTRO in there, but the non-performing loans kept rising and rising. And the key assumption that time will heal did not work. Why did it not work? Because the 5-year NPL that was issued in 2007 became a 10-year non-performing loan. It got restructured. We're already in the Japanese problem where the more you wait, the portfolio never heals because it gets constantly rolled over. And to me, this is what the ECB should go after. This is what's clogging the European banking sector, and by association, the entire European economy. It's these non-performing loans and the fact that European banks are still capital strained, and whenever they get a new euro, they'd much rather buy a 10-year Italian bond at 2%, which weighs nothing in the risk Basel weighting and makes them look good, rather than lend to an Italian corporation at 8% because they would have to put €1 of capital for every euro they lend. And they just don't have that euro in capital to lend right now. Now, what do you do?
Short.
If you think you have a deflation in Europe and we're going to have QE, dividend yield. It's not the most exciting, but that's what worked in the US. I mean, every time we had QE announced in the US, the best sectors were telecom, healthcare, staples. Basically, people get squeezed out of the fixed income sector and they buy yield. In Europe, you can find that European telecom has a dividend yield of about 5% now. 5% dividend yield, 1% deflation, 6% real yield. Not a bad place to buy. The other argument in favor of dividend yield is the valuation. In this chart, I take the median PE of the stocks with the highest dividend growth minus the PE of the one with the highest dividend yield. So when it's green, it means dividend growth is expensive. When it's blue, it means dividend yield is expensive. In the US, this chart is reversed. In the US, dividend yield is very expensive because we came through 3 cycles of QE that people have been hunting for yield, and growth is very cheap. In Europe, it's the exact other way. Because there's so little growth in Europe, everybody's been doing the same thing. Everybody has bought the high-quality international name, the global exporters, the Nestlé, the Novartis, the Hermes, LVMH. The few companies that were able to have growth are extremely pricey in Europe. On the other hand, nobody wanted to touch Telefonica, EDF, GDF Suez, Enel in Italy, like the telecom, the utilities, the banks. Nobody wants to touch them. They like the dirty sectors that only sell in Europe, so they feel quite cheap. So on a relative valuation basis, I think it makes sense to go with dividend yield over dividend growth. Next idea, I'm not sure whether it's an idea or an illustration of Europe's ailment. Here I looked at the performance of European companies based on what they do with their cash. So you can do 4 things with your cash. You can pay a dividend, you can announce a buyback, you can reinvest it, or you can do nothing. Just sit on it. What has been the best performing strategy in Europe if you're a corporate CFO? Do nothing. Just sit on it. And to me that tells 2 things. One, the whole great investment plans that you hear floated around in Europe, the 300 billion euro investment here and there, is not going to work. I mean, because CFOs are not stupid. They are doing what the market is telling them. Mr. Juncker might tell them you need to invest, we need to have infrastructure spending in Europe. Companies themselves, they have an incentive, they have a reward for not investing, so I don't really understand why they would invest. The second thing that it tells is that the market is getting ready for deflation. I mean, if you have deflation, this is the best strategy. You just sit down. You don't do any capex, you try to defend your margin, you have a high cash balance because real rates are still positive, you're fine. It's the best strategy, just wait and see. And the market has already traded as if Europe went through deflation. And you can see the the lines with the basically around here, like buybacks, dividends, and cash were about the same level. And it's really since we got into that deflation period that the cash holding has really been rewarded by investors. Third idea, so here I was, it was after the October correction, and a lot of people were like, well, but you know, maybe you can find diamond in the rough. You know, yeah, Europe has a lot of problems, but I'm sure there has to be some little company out there that's doing something that's really great and it's not being recognized by the market and so forth. And I'm not really a stock picker, so all I did here was look at the basic filter. You want to buy companies that have a price of 3, free cash flow yield above 8%, positive earnings revision, and long-term EPS growth above 4. Really not that hard, honestly. I mean, I don't think the criteria are that stringent. Yet, in the intersection of that, just 3% of European companies pass this very simple value criteria. And to me, that really tells me that, you know, if you can't find a good stock to buy, maybe you should be buying stocks. Here, I added another criterion because now everybody's very smart and everybody, oh, you need to buy companies that have good exposure to the US and negative exposure to the dollar. So I said, I'm going to keep my value criteria, and I'm going to add that I only want companies that have positive sensitivity to the US dollar and negative sensitivity to the oil prices. Less than 1% of European stocks pass the criteria. And that was before, that was as of Q3, so that's even before oil prices fell. I'm sure it's probably worse. So if I look at these companies, the ones that passed, what pops up is insurance. A lot of insurance companies are still somewhat cheapish in Europe because they're financial sector. They benefit from QE because they're owners of assets and asset prices go up with QE. They have good global business, like if you have Allianz or AXA, they're very good emerging market play. So they benefit from the weak euro. So that would be one sector that I think I would look at. But overall, we're really talking about a kind of a very small investable universe. Conclusion, yeah, deflation, normal, just do it. Lower price is not going to help Europe. Valuations are not really cheap. QE is not going to work. Okay, maybe we should do Q&A before I proceed.
So what's the bright spot? If it's looking bad across every kind of metric, is it a great short, especially sovereign bonds?
Not necessarily. The bright spot, I mean, short term, you will have QE. I mean, he's announced it. He's committed to it, and I mean, if he doesn't do it, he will lose all credibility. So that can keep the thing afloat for some time. Certainly on the credit side, I mean, yeah, I know yields feel really tight in Europe and spreads are ridiculous, but it's not really about your perception of value, more is there someone who will buy at a higher price than you? And I think if the ECB goes in, and if we really do have deflation in Europe, people will buy fixed income. So not necessarily short. And then when you're asking what's the positive, there's one big positive that I haven't touched upon. It's the collapse of the euro. That is a true positive for Europe. I mean, I think earnings growth in Europe next year will vastly outpace that of the US just because of currency effects. Basically, we have deflation domestically. If you are a European exporter, suddenly you have 13% more revenue, your cost base is the same, your profit will increase by 1 over your margin rate. So we'll have the kind of earning explosion in Europe that we had in Japan. Like after Abenomics was announced in Japan, earnings have doubled, sometimes even tripled in Japan. Now what happened at the same time is that the multiple compressed. Because the market is not like really stupid, it understands that it's a kind of, to some extent, a currency illusion. But at least in Europe, I think every quarter we'll start to have positive earnings surprise, even if it's only due to currency effect. Yeah?
Two questions unrelated. One is on the non-performing loans, there's a lot of U.S. private equity money and hedge fund money going in and gobbling up these non-performing loans, and there's more and more competition for those loans that should be increasing those prices. So I wanted you to comment on that. And in this Europe, since you're good at asset allocation, how do you see that influencing the U.S.
Mm-hmm.
Eventually?
Okay. Non-performing loans, I really hope you're right. The question is, how much was taken out versus how much is coming in. I mean, if I look at Spain, I didn't talk about Spain, but yeah, non-performing loans in Spain are starting to drop. Either its credit is improving or they're being able to offload some of it. But Spain has done a few good things. They set up the bad bank, they restructured things, so the clearing mechanism you're talking about, the clearing mechanism you're talking about can happen because assets have been written down, repackaged and all that. I don't think it's the case in Italy. And then you have a pipeline that's growing. I mean, in France, French banking sector is fine because we had a big bank, we had a credit union scandal in the 90s, so we were not like that leveraged, but non-performing loans are rising quite quickly in France.
Yeah.
I mean, when you have 13% plus unemployment rate, declining real estate prices, which is the case in France and in Italy, increasing corporate failures, I mean, it hits the bank, and consumers are getting squeezed. So, yeah, and I hope you're right. I hope there is capital that comes in and helps figure it out. But you also have all the pipeline that's coming in. And it really a matter of how one moves versus the other, and whether the banking sector is interested in getting rid of it or is trying to pull back. What was the second question?
The U.S. How if this persists, how will this affect the U.S.?
Historically, I mean, Europe has never really. I don't think there has been a real case of Europe dragging the U.S. into recession before. That's the beauty of the U.S. I mean, it's such a big insular economy. I mean, that's your privilege, right? You can forget about the world. I mean, you issue your own debt, your own currency. 70% of the economy is your own consumer. Everybody seems to be bullish on the U.S. So, and also I think part of it is, I mean, sometimes there's a circulation of money, right? I mean, if people are really bearish on Europe, if people don't want to touch emerging markets because Russia is crazy and China is slowing, if people are having doubt about Japan, I think part of it is just okay, well, the U.S. maybe the kind of restudied good agent. So I don't think Europe. Europe has been basically sidelining for 3 years. That hasn't really hurt the U.S. all that much. I mean, unless we have my last caveat was if we do have the really negative scenario, I was kind of highlighting of a populist winning in France or somewhere else, and then a euro breakup and a big banking crisis, then you could have contagion. But if it kind of remains just mediocrity in Europe, I think the U.S. can just ignore it. Yeah.
Yes, I think you started alluding to it a little bit, the structure of the EEC, and given that you've got one central bank and of course different economies, different needs, and if you carry this through the thought about maybe the downward spiral possibly in the euro, well, what happens to the EEC and the concept of separating the monetary systems and so forth, almost like a breakup? What are the odds of that, and where do you see the forces driving it?
Well, oddly enough, I think this was the plan all along.
Excuse me?
What we are now was the plan from the Maastricht Treaty.
Right.
Jacques Delors was the father of the euro, was a very smart man. He knew, and if you didn't know it, Margaret Thatcher probably screamed at him that you cannot do a monetary union without a fiscal union. His whole idea was one would lead to the other. I mean, the dream in Brussels was always to integrate Europe, the ever closer union. And doing the monetary union was the way to get there. It was just a matter of time before you would have the crisis for the reason you mentioned. The idea that Jacques Delors had was, well, now you're halfway across the river, you're already wet, you might as well, cross it. And maybe that's the end game. Maybe we have, populists win, you have an open debate all over Europe, and people really start thinking about it, the cost of breaking up the euro is so high, but it will need to get out in the open. You can't do what we had for the past 50 years in Europe, where you build Europe between well-behaved people and technocrats in Brussels, and ignore these stupid voters because they don't know what's good for them. I mean, they want to sit at the table, and that will bring a mess to it. And potentially, what could be a trigger? Greece, I don't think is a trigger. I mean, Greece can either be bullied or can be ignored. And I think both are happening now. Spain, like they have elections in the fall. They have this Podemos party, which is in the lead, but who knows how long it will last. I mean, whatever. The one that really worried me the most, I mean, maybe that's my own bias, but it's France. I mean, because you really cannot do a euro without France. And in France, it really is. Like, I mean, if there was a taboo just, 10 years ago, I mean, you couldn't go out and say, well, I think the European Union was a dumb idea and it's been hijacked by Angela Merkel and we'd be much better off under the French franc and there are way too many migrants in France. I mean, you couldn't say that. People would look at you like, like you've done something very politically correct. Right now, it is mainstream discourse in France. It has changed so much. And I think it will keep going there. I mean, you've seen what's happening in France so far. I mean, it's not a like. Yeah.
So you say QE won't work, and it's not going to work to solve problems, but will it work to lift asset prices like stock values, like it has here?
I think, yeah. I mean, it seems now the markets are kind of like a Pavlov's dog. He hears the bell and he starts salivating, regardless whether the food consumed or not. Yeah, because of that, but solely because of that. I mean, how does QE lift asset prices? Because you reduce the discount rate, right? You are. While in Europe, your discount rate, and as I was saying, like how much lower is the German 5-year going to fall now? It's minus 11 basis points. I mean, the marginal effect of QE will be so much lower than LTRO when you went from 700 basis points to 200 basis points. So my best guess, unless he announces something really creative and smart, which is always possible, you never know with Prada, he's a smart guy, is that, yeah, you get a pop, people are happy, and then, a few months later, you get back PMI, bad inflation number, whatever, and then people say, oh, it didn't work, and then you get a pop. And, yeah.
This is kind of part of my question, but thinking about the experience in the U.S., particularly QE2, one of the benefits was not necessarily that government rates or borrower rates were down, but more so that investors got pushed out the risk spectrum. Mm-hmm. And so if you think particularly about the impact that could have on non-performing loans to the extent that you have marginal investors and particularly fixed income securities in Europe that then get squeezed out of safe haven bonds and forced out the risk spectrum, don't you think that could have some type of ancillary impact similar to what it had in the U.S.? I mean, that's what happened. That's where you saw that huge run up in like loan funds and ETF funds here, which had much more of an impact than the actual fact that like mortgage rates were lower by 50 basis points.
Yeah, I mean, there is a lot of truth in what you said. That's certainly when it applies to the U.S. One difference that I would put in Europe is the role of the banking sector is so much larger in Europe than it is in the U.S. You have a lot less, private equity capital, pension fund money, even just private, like, RIAs and all that. I mean, the capital markets are dominated by banks and insurance, and so banks and to a lesser extent insurance are driven by capital adequacy ratios. So maybe they would like to move up the risk spectrum, but at the same time they have to, it's extremely punitive, I mean, it makes, why you have to put €1 of capital for a corporate loan versus 0 for a Portuguese bond. I mean, it makes no sense, but when you have a capital, like I said, making sense as capital constrained, they may not always do the smart idea, and especially if you have the economically sound idea. If you have deflation in Europe, your tiny yield on safe assets is still good because you have deflation at home. So will you really move up the risk spectrum when you have all these non-performing loans? Maybe. And the second thing that I'd like to point on that is the market's a lot smaller and structurally smaller. That was one of the things that came up when you announced the ABS QE. He said, I'm going to buy 1 trillion, get my balance sheet up by 1 trillion. The entire ABS market was 1 trillion euro. It's a lot smaller. And there is a structural reason why it's smaller. In the US, you can't do a structured product with a credit card loan in Seattle and a credit card loan in Florida. In Europe, this credit card loan in Italy will have a very different legal system, investor protection, bankruptcy law than it would have in Denmark. So a lot harder to securitize in Europe, and that's why it's like the whole notion that, oh, the ECB will buy securitized product, and then the market will create them for them. A lot harder to do.
We have time for one more question.
Yeah.
Vincent, could you give us your thoughts on Russia and what's happened there between sanctions and oil and the collapse of the ruble? How that's going to impact their ability to debt coverage, or debt service, covered debt service, and risk of defaulting on their debt?
Really the debt in Russia is private. It's the debt of, Gazprom and some of the big oil. So the Russian government is trying to surplus for years. We have almost no debt. Russia still has access to cash. I mean, this is yes, Europe just a mess of it, but Gazprom still has access to foreign currency. I honestly I don't think anything is very good this summer. I apologize, but yeah, maybe they do default, but I don't think it's all that big, and there's not all that much Russian debt out there. So I wouldn't see that as a a very big risk for market stability overall. But that's a very
Handful of French banks.
yeah, so there's now as big, yeah. I mean, some banks have a big interest in Russian. That's good.
One more quick question, maybe?
It's Russia related, but going into Europe. So several people out there are talking about, let's say, a 50% chance of another action from Russia then having to be sanctioned by Europe and the U.S. How do you see that? Do you see that as a catalyst for something really bad in Europe, where they don't have access to heating oil, or do you not see that as a big risk?
Right, it's very intertwined. I mean, Europe needs Russian gas. Russia needs euros and dollars. I mean, even at the worst of the Cold War, they never cut off the gas taps to Europe. I mean, when it happened back in 2009, it was Ukraine was the problem. They wouldn't use the pipeline that was for Ukraine because the Ukrainians didn't pay the debt, and they were worried that Ukrainians would siphon the gas out. Now they have a Nord Stream pipeline, so Russia can export to Europe specifically. I mean, Russia cutting gas supplies to Europe. I mean, wow. Then they really have nothing. I mean, they're really like going back to the Stone Age. I mean, they really have nothing left. I mean.
Okay, so you don't see any risks for that?
No, but again, I mean, it's one of these areas where, again, I must disclose. I mean, it's very hard to understand what might be going on in the head of Vladimir Putin.
Which is why it was brought up. Yeah.
Thank you very much, Vincent.